Meet Sarah, a 28-year-old teacher who once felt overwhelmed by the idea of earning $5,000 monthly in dividends. Starting with just $10,000, she faced skepticism from friends and family. Frustrated but determined, Sarah embarked on a journey that seemed impossible. Did you know the average dividend yield is only about 2%? Sarah's story defies these norms. In this video, we'll reveal Sarah's exact steps from her first stock purchase to hitting her $5,000 monthly dividend goal. You'll discover how she overcame challenges and turned her modest savings into a dividend powerhouse. Want to know how she did it? Even if you're starting small, you'll learn how to create your own path to financial freedom. Sarah's journey began with skepticism. As a 28-year-old teacher earning around $45,000 a year, generating $5,000 in monthly dividends seemed as distant as winning the lottery. With $10,000 in savings, slightly above the average American's, Sarah faced a daunting challenge. That $10,000 was respectable, but compared to her goal of $5,000 in monthly dividends, the gap seemed insurmountable. How could such a modest amount bring that financial chasm? Sarah's doubts weren't unfounded. She'd heard the misconceptions about dividend investing, that it was only for the wealthy, that you needed a fortune to start, and that returns were too slow to matter. One belief that held her back was the idea that you needed at least $100,000 to see meaningful returns. Everything changed when Sarah learned about a colleague's success story. This fellow teacher had started with just $5,000, less than Sarah's savings. Through strategic planning, her colleague had built a substantial dividend portfolio. This revelation forced Sarah to reassess her assumptions. She began to understand that dividend investing wasn't about having a massive lump sum. It was about consistency, patience, and making informed choices. The key was setting realistic expectations and understanding that building a significant income stream takes time. Sarah discovered the power of compound interest and dividend reinvestment. She learned that modest investments, when combined with compounding, could grow substantially over time. Typical dividend yields ranged from 2 to 5%, depending on the stocks chosen. The more she researched, the more her excitement grew. She found case studies of individuals who started with similar amounts and achieved significant growth. Their secret? Reinvesting dividends and carefully selecting quality stocks. As her understanding deepened, Sarah's skepticism melted away, replaced by possibility. She realized her $10,000 wasn't a limitation, it was a launch pad. With the right approach, it could be the foundation of a robust dividend portfolio. Inspired and armed with knowledge, Sarah decided to give dividend investing a try, setting a 10-year goal. She knew there would be challenges, but the potential reward, financial freedom and passive income, was worth the effort. As Sarah delved into dividend investing, she uncovered a strategy that would become the cornerstone of her financial future. She focused on companies that not only paid dividends but also increased those payments year after year, potentially turbocharging her journey to $5,000 in monthly dividends. Initially overwhelmed by the sheer number of dividend-paying stocks, Sarah pushed through her research. She learned the crucial difference between dividend yield and dividend growth, leading her to the concept of dividend aristocrats, companies that have consistently increased their dividends for at least 25 consecutive years. Sarah discovered that many dividend aristocrats had outperformed the broader market over the past decade. She found their average dividend yield tends to be around 2 to 3%, with some offering yields as high as 5 to 6%. She also learned about dividend growth rates, with top performers boasting annual growth rates of 10% or more. Developing her criteria, Sarah looked for companies with a strong history of dividend payments, consistent growth, and solid business models. She aimed to hold between 10 to 20 different stocks for diversification. Sarah considered several dividend aristocrats. Johnson & Johnson impressed her with its healthcare presence and steady dividend growth, but potential legal liabilities concerned her. Procter & Gamble's consumer staples portfolio caught her eye, though its slower growth gave her pause. Coca-Cola's global brand power was attractive, but she questioned its ability to adapt to changing consumer preferences. To balance her portfolio, Sarah spread her investments across different sectors, including healthcare, consumer staples, technology, utilities, and real estate. With her strategy in place, Sarah made her first stock purchase. Her hand trembled as she clicked buy on her brokerage app, investing in Johnson & Johnson. A mix of excitement and nervousness washed over her as she confirmed the transaction, smiling at the thought of her first dividend payment. Sarah remained aware of potential pitfalls, such as chasing high yields. She opted for a balanced approach, considering both yield and growth potential. With her newfound knowledge and carefully crafted criteria, Sarah felt ready to build her dividend portfolio towards her $5,000 monthly goal. Have you ever stared at a dividend check and felt a twinge of disappointment? That's exactly what happened to Sarah. As she looked at her first payment, she wondered why her investment wasn't growing as fast as she hoped. The answer lay in a powerful strategy that would transform her modest investment into a wealth-building machine. Sarah was tempted to spend the extra cash, but remembered her mentor's advice about the dividend snowball effect and decided to dig deeper. She discovered that by reinvesting dividends, she could purchase additional shares, which would then generate their own dividends, creating a powerful compounding cycle. The concept of compound interest in dividend investing fascinated Sarah. She learned that over time, this strategy could significantly reduce the initial capital needed to achieve her financial goals. By consistently reinvesting dividends for 10 years, she could potentially reduce the required investment from $700,000 to about $400,000 to reach her target monthly income. Sarah's research led her to dividend reinvestment plans, or DRIPs, which allowed automatic reinvestment of dividends into additional shares, often without fees. She quickly set up DRIPs for all of her stocks. To understand the impact, Sarah created an example. Starting with 100 shares of a $50 stock paying a 3% dividend yield, she calculated, after 5 years, 115 shares generating $172.50 in annual dividends. After 10 years, 133 shares generating $199.50 in annual dividends. After 15 years, 154 shares generating $231 in annual dividends. Sarah shared her strategy with a skeptical friend. "But isn't that just pennies?" her friend asked. Sarah explained, "It may seem small at first, but over time, those pennies add up to dollars, and those dollars can grow into hundreds or even thousands." As Sarah watched her share count increase, she felt motivated to stay committed to her long-term strategy. She reminded herself that this approach required time to show significant results, focusing on potential long-term gains rather than short-term increases. The months turned into years, and Sarah diligently stuck to her reinvestment plan. She resisted spending her dividends, knowing each reinvested payment contributed to her future financial freedom. Finally, after 2 years, Sarah reached her first milestone, $100 in monthly dividends. It wasn't life-changing, but it proved her strategy was working and represented a significant step towards her ultimate goal. Sarah's journey was about to face its toughest challenge yet. As she entered her 4th year of investing, the stock market crashed like a thunderstorm on a sunny day. The Dow Jones plummeted 30% in a matter of weeks, wiping out years of gains. Panic spread like wildfire among investors, but for Sarah, this crisis held an unexpected opportunity. Could the key to accelerating her dividend income be hidden in this market chaos? As her portfolio value plunged, Sarah felt a knot in her stomach. The fear of losing everything was real, but instead of panicking, she remembered her long-term strategy. This was her chance to put her knowledge to the test. Sarah focused on buying the dip, purchasing shares of quality companies at lower prices. It was a bold move that required courage and conviction in her investment choices. Surprisingly, many of her dividend-paying stocks maintained their payouts despite the market turmoil. This stability provided a buffer against volatility, like a sturdy umbrella in a rainstorm. It reminded Sarah why she chose this strategy in the first place. To stay focused, Sarah avoided constantly checking her portfolio. Instead, she analyzed company fundamentals, ensuring they remained strong despite economic challenges. Her emergency fund proved invaluable, allowing her to avoid selling stocks at a loss to cover expenses. As Sarah gained confidence, she made a bold decision to increase her investments. She learned that lower stock prices often lead to higher yields on new purchases. By investing more during this period, she was setting herself up for potentially enhanced dividend income once the market rebounded. The following months were a roller coaster of emotions and market movements. Sarah watched with mixed feelings as her portfolio fluctuated, but she held firm, continuing to reinvest dividends and make regular contributions to her investment account. As the economic storm cleared, Sarah's portfolio emerged stronger. The additional shares acquired during the downturn now provided more dividend income. Many of her dividend-paying stocks not only recovered, but thrived in the post-crisis environment, proving their resilience by maintaining their business models and building loyal customer bases during tough times. Sarah's journey was about to enter a new phase, one that would test her resolve and push her investment strategy to its limits. As her portfolio recovered from the economic downturn, she discovered a powerful concept that would change everything: paying yourself first. Realizing she needed to dramatically scale up her investments, Sarah set up automatic transfers to her investment account on payday. This ensured a portion of her income went straight to her dividend-growing portfolio before addressing other expenses. Sarah knew she needed to increase her savings rate beyond the average 7.5% that many Americans manage. As a teacher with a modest salary, this presented a unique challenge. Sarah got creative, finding ways to trim her budget. She cut her cable subscription and reduced dining out, allowing her to boost her savings rate to 15%. Sarah also tapped into the power of side hustles. By tutoring students after school and on weekends, she managed to earn an extra $1,000 per month on average. This additional income became a game changer, allowing her to significantly increase her investment contributions. With her original 7.5% savings rate, it would have taken Sarah about 12 years to reach her $1,000 monthly dividend goal. By increasing her rate to 15% and adding her side hustle income, Sarah cut that time nearly in half, reaching her goal in just 7 years. As Sarah's investment strategy evolved, she embraced dollar cost averaging. By consistently investing a fixed amount at regular intervals, regardless of market conditions, she mitigated the impact of market volatility. This approach meant buying more shares when prices were low and fewer when prices were high, ultimately lowering her average cost per share over time. The psychological impact of reaching key milestones cannot be overstated. When Sarah's monthly dividends hit $500, it provided a massive boost to her motivation. She could see her strategy working, her dividend snowball growing. This milestone reinforced the benefits of her consistent investing approach and encouraged her to push even harder towards her goals. 7 years into her journey, Sarah finally hit her $1,000 monthly dividend milestone. It was a moment of triumph, but also one of reflection. She had come so far from her initial $10,000 investment, proving that with dedication and the right strategy, significant dividend income was achievable even on a teacher's salary. Did you know that only 1% of dividend investors ever reach $5,000 in monthly dividends? It's a rare achievement, but Sarah was determined to join that elite group. As she entered the final stretch of her dividend investing journey, she uncovered strategies that would transform her portfolio in ways she never imagined possible. With $1,000 in monthly dividends already flowing in, Sarah faced a new challenge: maintaining motivation as progress seemed to slow. But she discovered a secret weapon that revolutionized her approach: the power of yield on cost. Imagine this. Sarah starts with a high-yield stock paying 8.42%. After 15 years of reinvesting those dividends, that same stock could be yielding 30% on her original investment. That's yield on cost in action. It's like a compound interest supercharged. Sarah optimized her portfolio for both yield and growth to reach her $5,000 monthly goal. She found the perfect balance between high-yield stocks for immediate income and dividend growth stocks for long-term gains. She dove into research, analyzing companies with strong dividend growth histories. She looked for businesses with solid financials, consistent earnings growth, and a track record of increasing dividends year after year. These dividend growers became her portfolio's backbone, providing a steady stream of increasing income over time. Sarah leveraged tax-advantaged accounts to boost her dividend reinvestment strategy. By using Roth IRAs and 401ks, she ensured her dividends could compound more efficiently, free from annual taxes. This decision had a massive impact on her long-term results. As her portfolio grew, Sarah witnessed the snowball effect of dividend investing. Each reinvested dividend brought more shares, generating more dividends in a virtuous cycle that gained momentum monthly. The journey wasn't always smooth. During a market downturn, Sarah's portfolio dropped significantly. She questioned her strategy, wondering if she should switch to safer investments. But she remembered her long-term goal and the power of dividend growth. She stayed the course, even buying more shares at discounted prices. This decision paid off when the market recovered, accelerating her progress. In the final years, Sarah fine-tuned her portfolio allocation, balancing dividend growth stocks and high-yield stocks. This approach allowed her to benefit from both steady income and potential capital appreciation. As Sarah approached her goal, the anticipation built. Would she really quintuple her dividend income? Then, 10 years after she started, Sarah logged into her brokerage account and saw the number she'd been dreaming of: $5,000 in monthly dividends. Sarah's journey from $10,000 to $5,000 monthly dividends showcases the power of strategic investing. You don't need to be Sarah to achieve similar results. Start building a diversified portfolio of high-yield stocks, no matter how small your initial investment. Consistently reinvesting dividends can significantly accelerate your progress. It's like planting a money tree that grows faster each year. Patience is key. This isn't a get-rich-quick scheme, but a long-term strategy. Ready to take control of your financial future? Start today, and in a decade, you might be sharing your own success story. Imagine the freedom of a steady, passive income stream supporting your dreams and lifestyle.